In today's market wrap, I'll just cover a few of the markets quickly. The dollar is following through with what I've been suggesting was going to happen. Failed breakout. Everybody got long, expecting that this breakout was going to lead to a strong follow through and much higher prices. And as I warned, way too late in the daily cycle, highly likely that the breakout would fail and everybody would get caught on the wrong side of the boat. That's what's happening. Another interesting aspect during the advancing phase of a intermediate cycle, price tends to rebound quickly from oversold conditions and then return to overbought. So you can see here, doesn't stay oversold for very long. Same thing here, on down the line. Every time the market gets oversold, it quickly rebounds and moves back up. And now that pattern is changing. We got oversold, brief little bounce, didn't get anywhere near becoming overbought, and is now back in the oversold conditions. That is usually a sign that an intermediate decline has begun. Um, I'm still, we should still get some kind of dead cat bounce here soon, but right now the dollar's working its way down into a daily cycle low. The cycle could bottom, as early as the end of this week or sometime next week, and then we should get some kind of a bounce. But at this point, that bounce may be contained by this 50-day moving average, which is looks like it's preparing to roll over, which it should. During an intermediate decline, the 50-day moving average should turn and move down. So things are progressing as I expected in the dollar. Quick look at the euro, which is the flip side of the dollar index, and the exact opposite is happening. The euro, which had been in a downtrend, which means that these overbought conditions are quickly sold into, that has changed, and now we are starting to stay overbought, which is an indication that an intermediate advance has begun. Same thing with the euro. We should get some kind of corrective pullback pretty soon. We've got resistance here at about the 18 to 1850 zone. That would be my best guess as to where this initial surge off the bottom would probably find some resistance and then give us some kind of a pullback, maybe even back to this 50-day moving average before resuming the move higher. But this intermediate rally should still have at least a couple of months to go, and I'm kind of expecting that it could last all the way into the elections. Moving on to the stock market, the 10,000 is firmly in the crosshairs. The Nasdaq has broken above 8,000, which kind of surprised me. I thought we might take a breather at 8,000, maybe come down and produce a daily cycle low, but it's broken through that level. I'm still anticipating 10,000 by the middle of next year. I don't know that I would want to be. I certainly wouldn't want to be entering long positions right now. If you're holding a long position, you might want to hold it and trail a tight stop. But we haven't actually had anything that looks or that I can confirm as a daily cycle low since the end of June. This is, if I'm not mistaken, day 43 of this daily cycle. So we're really mature in this daily cycle. We're really overbought. Sentiment is starting to become too bullish. And we should get some kind of pullback here in the not too distant future. And let me widen this chart out a little bit. Okay, so we haven't actually had an intermediate degree decline since February. So we are 29 weeks into this intermediate cycle. So another reason why I would not be trying to chase this rally. And if you are long the stock market, I would would probably trail a tight stop. We're overdue for an intermediate degree correction, and I've noted this before, that when a cycle, and it doesn't matter whether it's the daily cycle, intermediate, or yearly cycle, it doesn't matter what degree, but when a cycle right translates to an extreme degree, often what happens is the move into the cycle low will be very sharp. When it's an intermediate degree, it can often unfold as some kind of a mini crash. The reason being is the cycle just runs out of time to produce a normal ICL, which in a normal case would unfold over anywhere from 4 to 6 weeks. But if the cycle right translates to an extreme degree, as we are right now, 29 weeks into the cycle, then you run the risk of the cycle having to produce an ICL in a very short period of time, just simply because the intermediate cycle has just run out of time to produce a normal 4 to 6 week correction. And you can see that's what happened here in February. That this ICL began and completed in 2 weeks. So the whole intermediate degree drop occurred in the span of only 2 weeks. I think there's definitely risk that the same kind of scenario could happen again here, simply because this intermediate cycle has become so extremely right translated at 29 weeks. So you want to be careful if you're long here. I think there is definitely risk that when we do get an intermediate correction, it's going to unfold in the very same pattern as it did in February, and we'll get some kind of mini crash event that occurs very quickly, maybe in the span of only 8 to 10 trading days. Here's another problem. The market is just stretched way too far above the long-term moving averages. Again, this is the recipe for what could unfold as some kind of a mini crash event sometime in probably the not too distant future. And since the Fed is going to raise rates at the next FOMC meeting at the end of September, the opportune time for this to happen would be between now and maybe the second week of September. And if it does, then that gives the plunge protection team time to rescue the market and push it back up towards or near the all-time highs in time for that rate hike. So just another another warning flag that you need to be aware of if you're long this market, and especially if you're thinking of chasing this rally. I think there's just too much stretch between price and this long-term moving average right now. Too much risk of the next ICL occurring as a mini crash very quickly. And finally, just a quick word on gold. As I said a couple days ago, I'm pretty sure that we've completed an intermediate cycle low. We don't quite have a weekly swing yet. I think gold needs to get above 1221, I think, but we're pretty close. And with the dollar confirming that it's almost certainly in an intermediate decline, then the gold should continue to rally as the dollar falls. And like I said, I'm not really expecting the dollar to complete a final intermediate cycle low until late October, early November. So gold should have plenty of weeks ahead to rally. The weekly stochastics are starting to emerge from oversold conditions. The one caveat, of course, is that the daily cycle of the dollar is pretty mature, and we should get some kind of a bounce, even if we only expect a dead cat bounce. Sometime in the next, let's call it 5 to 10 trading days, the dollar should give us some kind of a 5 to maybe 8 day bounce, and that could pressure gold and at least slow down the initial move out of this intermediate cycle low. Would really like to see gold get above this high right here at 1237 before the dollar gives us that short-term bounce, and I think that would limit any damage that gold might suffer during that 5 to 8 day bounce in the dollar. It wouldn't take gold down too far before resuming its upward trend into the end of October, early November. But it looks to me like we've got an intermediate cycle low here, but we're just got a little bit of short-term risk whenever the dollar decides to give us that short-term bounce that's due anytime now.